So the paper is joint with Jiang, actually. So if I cannot finish it, he will finish it for me. Also joined with Xin Hu, who is a professor at Hong Kong University. So the main focus for us here is how we measure liquidity. So liquidity has been a very important topic both in academic field as well as in practitioners' world, especially in recent years since the 2008 financial crisis. So liquidity is something that when you are in a very illiquid environment, you can feel it right away. And when you're in a very liquid environment, you can feel right away too. But the problem is that, academically, we don't have a very strong measure of liquidity. So if you want to take this concept or this idea at a more advanced quantitative level, there isn't a consensus measure of liquidity, especially liquidity like the crisis-related liquidity. Part of the problem is that a lot of measures that are influenced or are being impacted by liquidity is also contaminated by other factors. For example, during 2008 crisis, everything spiked up. You look at LIBOR spread, you look at the CBOE volatility index, you look at a lot of measures of, related to liquidity, you see that they all spike up. The problem is that these measures are contaminated by other things. For example, LIBOR spread or credit spreads are also related to the banking sector's solvency risk. So it's always a combination of liquidity and the solvency that makes the measure of a pure measure of liquidity difficult. This is the main motivation for our paper. We want to come up with a clever measure that is pure and not contaminated. So where do we look for it? It's very counterintuitive, but we actually look for it in a market that's very liquid, that is essentially free of credit risk, but there is some credit risk. And the market we are looking at is the Treasury market, the U.S. Treasury market. And the objective of this paper is to look at the Treasury market's behavior and link that arbitrage capital movement in the Treasury market to that broader market liquidity and to detect the liquidity crisis. And the reason why Treasury market is a very good market to look at is because, as I said earlier, it's pure, it's very essentially free of credit risk. It is the market where everybody comes. You think about what is the most important market across the world. Treasury market is a very central place. Okay? So the idea here is very simple, and this is where the name noise comes in. And as we try to be cute in the title, we said noise as information for illiquidity. So where does noise comes in? Where does noise come in? The noise comes in through this idea, and these are the last two bullet points. The idea is very simple. If arbitrage capital is abundant, so everybody comes in, hedge funds, prop trading desk, investment banks, they all come in during normal time, the arbitrage capital will keep the Treasury curve very tight. Not too much room for further arbitrage activity. Okay? So in that sense, noise level is very low during these abundance of arbitrage capitals episode. But during financial crisis, then arbitrage capital goes away, either because limited of capital or because people are just scared. They don't want to commit their arbitrage capital. So during crisis, you're going to see Treasury yield curve being very noisy. And the reason is because the previous arbitrage force is not there to keep it tight. Okay? So it's like when I'm healthy and very energetic, I keep my room very clean. When I'm sick, like I'm coughing, you go to my hotel room, you will see it's very messy. So that's the same analogy here. Okay? So I want to elaborate on the last point because that's the key, the central point of our paper by doing some numerical or some just graphical examples. So these are two yield curve, very normal looking. the yield curve level was around 8%. We haven't seen this high level of interest rate for a long time, so you could guess this was around 1980s. Okay? So the yield curve is upward sloping, and the x-axis here is the maturity of the different bonds, and the y-axis are the yields to maturity for these bonds. On the yield curve, so the yield curve is fitted by using all the points, the crosses and the pluses on that plot. Each point is a treasury bond. So it's a treasury bond of different vintage, and the only label here is their maturity. Okay? So some treasury bonds might be underrun, 5-year, 10-year underrun. Some might be, issued many, many years ago. Now it's having 3 years to maturity. So you have different points on the yield curve of a variety of treasury bonds. Okay? And you look at how they clustered around the yield curve. It's very tight. This is a normal looking treasury curve during a normal time. It's pretty tight. And what keeps them tight? Well, arbitrage capital. Now let me tell you what the date of these two curves are by introducing the red curve. So now we have 3 dates. The green lines are the blue lines are the day before the 1987 stock market crash, and the green line is the first trading day after the 1987 stock market crash, and the red line is the day off. Okay, now think about it. This is a very interesting observation because 1987 stock market crash was very much a stock market event. You look at the treasury market, what do you see? You see that all these dots are actually divergent from the curve. So it's a very messy day compared to the day before and the day after. And this is the central point of our measure. And this is what we call noise. And we call it noise because during, in academic research, I was trained at Stanford, a term structure person when I was at Stanford studying a very complicated models of term structure modeling. And we do that using the yield curve. And all these deviations, we call them noise. We academics are really interested in fitting the curve, but when the noise I just throw away. So the noise are really garbage in terms of academic studies. So what we do in this paper is picking up the garbage, basically picking up the noise and transform that noise to really valuable information. So I like to say we are like the alchemist transforming metals into gold. So that's pretty much the idea. And if I'm going to put things more quantitative for you, is that in the panel here, I have, in the legend here, we have quantitative numbers. These are the noise measures. So these are basically across the yield curve, you calculate each bond, how far away is it from the yield curve, and then sum over all the deviations. And the measures are in basis point. So if you're in the fixed income market, you're into this market, you see right away that during normal times, the day before, the day after, the deviations are pretty small. 4 basis points the day before and the 7 basis points the day after. But the day off, the noise measure was about 13 basis points. Basically says there are 13 basis points of deviation in the fixed income market that's left on the table, and the no arbitrage capital wanted to touch it. Okay? So during normal days, 13 basis points, believe me, 13 basis points in the fixed income market is a lot of basis points for you to explore. And during that day, nobody wanted to do it because of arbitrage, of liquidity issues. Okay? So that's one example. Another example was the 9/11s. So the blue line is the day before, very, very tight yield curve, only about 3 basis points. And the day off is the green line, it was about 4.6 basis points. And the red line are the day off. It's the first trading day off after the 9/11s. Okay? So again, you can see a big deviation, 12 basis point, spike up and a come down. The financial crisis actually makes our paper very much more interesting because you look at the previous two examples I give you, the 87 crisis, the 9/11s, they were kind of one-day event. But 2008 was a many day event, and it was a very deep crisis. So I'm picking 3 dates for you again. One is the day of Lehman going into bankruptcy. So that's the blue line here. You can see that it's a bit noisy, but on average it's about 6 basis point or 5.9 basis point. It's not a lot noise compared to the historical average. But the crisis really deepened as it goes through the red, the green. Okay? So at some point it becomes 17 basis point. And let me show you the entire time series of the whole noise measure. By the way, let me comment on this. You can see that now it's actually a very messy term structure by October 31st. And some traders will call this, some trader at London said that this, during the crisis, the term structure was so messy, it looks like a Picasso painting. So that needs some imagination. But basically the message, I hope it's very, very loud, very clear. You pick up those noises, and those noises contains information of how much arbitrage capital is available in the market, how much arbitrage capital is deployed in the market. And this is the central place for arbitrage capital, the treasury market. So we can do this more systematically. So this is a time series from 1980s. We can do this actually further back through 1960s. So 1980s through 2010, 2011. Okay? So you can see the ups and downs, and there are kind of bars around each point. So you can see the 87 crisis, which was the first peak, and you see the 9/11s, and you also see the LTCM crisis. So a lot of financial crisis shows up in that noise measure. And you can see the most prolonged crisis so far is the 87 crisis. So the last kind of, I don't know if you can see, the last bar here is the onset of the Lehman filed for bankruptcy. And you can see that it didn't peak, the noise measure didn't peak around that event. It took a while to really build up that illiquidity in the market, and then it calmed down eventually. So if you take, and also look at the magnitude, 87, 9/11s were pretty big events pre-crisis, but during the crisis, we are talking about 20-some basis point left on the table in the treasury market, 20 basis point. That's a huge amount of basis point left on the table in the treasury market. If you take a closer look, so this is the entire 2008-2009 crisis. You can see that onset of the Lehman really building up. So things really get, you read all these new books written by practitioners, by regulators, recounting the crisis in 2008-2009. You get the same feeling is that the crisis takes a while to build up, a lot of uncertainty, reluctance to deploy arbitrage capital, and then it peaked around the end of 2008. And it finally recovered around spring of 2009 when the stress test was done on the banks. So it was a pretty prolonged crisis. And if you plot this time series along with LIBOR spread, for example, one of the measure, the TED spread was one of the measure of liquidity, you will see that TED spread spike up quite a bit, but then it comes down pretty quickly. It was not as prolonged as this noise measure. Okay? In other words, TED spread contains more in terms of solvency, and our noise measure is more of a liquidity measure. Okay? So that's the first portion of the talk. Basically gives you the idea and give you the results. Well, for me, looking at this picture was, as an empiricist who loves to work with data, who loves to, extract information from the data, this was a very pretty picture to look at. But if you want to be pragmatic, you will say, well, okay, all you are telling me is that you know, when things go bad, your measure goes up. You know, can you be more useful, okay, other than this? Okay. So let's do the second stage of our paper, is that what can we use once we construct this quantitative measure of liquidity or illiquidity? So this is where we take our data to cross-sectional test. So I'm going to skip a few slides. So here, the idea is that once you come up with this measure, you want to show that this measure matters. This measure matters in terms of asset pricing. So we need to find the test assets. So we went through a lot of asset classes trying to find assets that are mostly influenced by this market, very broad market illiquidity measure. And finally, one measure, well, I have to confess, we went through a little bit of a data mining. Nothing worked. So we were going to give up. Then we thought, well, why don't we do hedge fund? So if you think about our measure, think about which asset class to test. Well, hedge fund will be the ideal place because they are the most active arbitrage capital. And, you know, other markets might not be as clean. You know, equity market might have equity market specific liquidity issues. Corporate bond market might have corporate bond market liquidity issues. But hedge funds, they are basically arbitrage capital, so they should be mostly impacted by this illiquidity measure. So this is what we do. We took hedge fund. Well, hedge fund, as you know, the data has a lot of issues. It's self-reporting, has survival bias, has a lot of issues. So we took data from 1994 to 2010 because through that period we have the graveyard funds, so it's not as contaminated as early data. So we took individual hedge fund data. We basically run a two-factor model here. So here, this is the equation. We run a two-factor model. One is our monthly changes of our noise. So this is one risk factor we really want to focus on. The second one is the stock market return. So this is a two-factor. We want to keep one factor that's really important, which is shared by most of the asset classes, which is the U.S. stock market. This is SP 500. So we run a regression for each hedge fund on these two factors. So basically, borrowing the idea of the CAPM, we want to know each hedge fund, what is their exposure to the broader stock market? So this would be the beta on the market. And what is its exposure to our noise measure? Basically, what is its exposure to illiquidity? Now, we put those two factors together so that you know that illiquidity spikes up when markets goes down. So we want to pick this exposure, which is the noise exposure or noise beta, above and beyond its exposure to market. Okay? So that's why we have this two-factor model. Once we do that, we sort all these hedge funds into 10 groups. So we have enough cross-section of hedge funds to sort them into 10 groups. And the first column here report the excess return, so the excess of the free rate. So these are the monthly numbers. So for example, the first row here, this number, 95 basis point, that's the monthly average return of our Group 1 hedge fund. Okay? So this is monthly excess return of a hedge fund all belonging to Group 1, excess of the risk-free rate. So 95 basis point. Compounding annually about 12%. Okay? So that's the performance of one group of hedge funds. And the bottom is our group 10. So it's about 23 basis point monthly excess of the risk-free rate. And numbers in the square brackets here are the T-stats. So a rule of thumb, if a T-stat is bigger than 2, it's a pretty significant return. So alternatively, return to information ratio is good enough. Okay? So we basically have those 10 groups. And how do we sort those 10 groups? We sort them by their noise exposure. So the third column here is the noise beta, which is the exposure of these hedge funds on this illiquidity measure. So let me guide you through a little bit on how to read this number. So if the noise beta is -1, it means that this group of hedge funds, they really suffer when illiquidity spike up. Okay, so these are the really hedge funds are exploiting. Basically, you think about 95 basis point, where it's coming from, and then you look at their exposure to illiquidity. The first thing that comes to your mind might be, they might be exploiting illiquidity. They basically are hugely loaded up on this illiquidity exposure. That's why the return is good, 95 basis point. Compared to the group 10, which within our sample has the lowest exposure to illiquidity measure. Let me do the number again. So this is a 0.69. This is the beta, and it's important, it's positive. Compared to that portfolio, it's negative. So this group of hedge funds, whenever the market is in crisis mode, like 2008, their return increase because they have a positive beta on this illiquidity measure. Okay? So basically, we have all these hedge funds lined up in terms of 10 groups with increasing very, very strong exposure of a lot of illiquidity measure, a lot of illiquidity risk exposure to actually hedging your illiquidity exposure. And then there are groups in between. And you look at their returns, you can see that nicely the returns line up as well. So this is actually exactly what we want to see. We want to see a lot of exposure, a lot of return, and we want to explain that return by coming from your hedge fund exposing to illiquidity. And here the return is not so good. Why? Because they are basically a hedge for this illiquidity risk. Okay? So if you do this two-factor model and then you look at the alpha. Okay? So this is kind of a very simple performance measure, just looking at return minus the risk-free rate. Here is a more sophisticated measure saying, well, hedge funds, we know that you might be exposed to this noise measure, so I don't want to count for that because it's very risky. So what is the alpha after I take into account of this exposure to illiquidity? You can see that the alpha basically goes away. So this is a pretty neat result coming from the hedge fund world by saying that this illiquidity measure, the noise measure we came up with, really matters in this market. Okay? Another interesting result is that you look at this group 1 and the group 10. You look at their performance, this is kind of the group fatality rate, or basically the percentage. These numbers are actually are not labeled wrong. So this is the death rate of hedge funds. So they die pretty easily. We're looking at, for the entire group pre-crisis, it's about 10%. Okay? And you look at these different groups. Remember, group 1. These are the ones in our portfolio 1 with a lot of exposure to illiquidity. Group 10 is the one that's give you some hedge to illiquidity. You don't see much difference pre-2008. And 2008 was really a tail event. So basically, during normal times, these two hedge funds, you couldn't tell them apart without having our beta measure. If you use our beta measure, even before 2008, you can already tell these guys from that guys. So I don't take a stand on what these guys, which group is better. These are different trading strategies, different approach to the market. But you want to know. You want to know among this group of hedge funds, if something bad happens, like 2008, what's going to happen to these hedge funds? What's happening to this group is very different to what's happening to this group because they are very low, they're very much loaded up on illiquidity, and these group actually give you some hedge. Okay? But what's interesting is that pre-crisis, you look at the death rate of these hedge funds, you couldn't tell them apart. But when tail events happen, like 2008, so this is 2008, you can see that the group 1 died more with a much higher death rate, 40% versus the other population. Okay? So in other words, this measure gives you a way to detect hedge funds, one group from the others. Okay? So this is one portion of the result. Another asset class that's actually very much related to arbitrage capital is carry trade, especially currency carry trade. So interestingly, we find that the same result shows up in the currency carry trade. So let me give you some numbers. So these are the currency carry trades result for developed currencies. So you basically have, again, the same idea. You're sorting them into different groups. So here we are not sorting them into our exposure to our liquidity measure. This is done by the carry trade strategy. You basically sort them by the interest rate of each of these currencies. For example, Japanese yen for the longest time was the currency in the bottom here. They are the base currency, the currency that you lend. And then the group one will be, say, New Zealand dollar, Australian dollar, pre-crisis. These are the high interest rate yielding currency. They are the target currency, or the let's just call them the target currency. You basically borrow from that currency, and then you invest in the other currency and capture the interest differential. And in terms of portfolio return, you can see that the base currency is close to zero, and the target currency gives you about 53 basis points. So if you do a currency carry trade to capture the difference between those two, you get about 53 basis points a month and about 6% a year. Okay? So that's a very conservative currency carry trade. Then you take those 6 portfolios. For each of these portfolios, again, you regress them on our noise measure and on the market systematic risk. You find that their exposure to our noise measure lined up too. Remember the group one in the hedge fund, these are the ones that really suffered during crisis. The group one here are the target currencies. So these are the currency that carry trade like to invest. They tend to really suffer during crisis too. And this you already see in the market. Currency carry trade unwind is not pretty at all. You unwind them during crisis and you lose money by doing so. So you basically get the same idea here, a very negative exposure, a negative beta on our currency, on our noise measure, meaning that these currencies really suffer. If you long these currencies, you suffer during crisis. And this, going back to the performance, which is the excess return, it's saying that where does currency carry trade profit come from? Well, it comes from this exposure to illiquidity. Once you take that out, again, you look at the alpha. Once you correct for exposure to our noise measure, you basically don't see those currency carry trade profit anymore. Alpha is close to zero, statistically insignificant. So basically, currency carry trade is another way of loading up on illiquidity and losing money during crisis. Okay? So this is another result we have using the cross-sectional test. So that's pretty much what I want to talk about today. So in conclusion, we basically come up with this measure, which is really simple, very intuitive. Doesn't need, between Jean and I just counted, we have 4 PhDs. I have 2, he has 2. So it doesn't need a lot of PhDs to do it. Doesn't need to do a lot of, I was trained as a term structure person, so I didn't need a lot of term structure modeling to do it. You just fit the yield curve, you calculate the noise measure, you get a sense of how illiquid the market is. And empirically, we find that it really shows up during crisis. And we look at the cross-sectional test, we find that it does do a pretty good job in those asset pricing tests. That's it for this portion of the talk. Given that I still have a lot of time remaining, I just want to add one remark since we are in Shanghai. I was born and raised here. So I was thinking, what relevance does it have for the Chinese stock market? I would say not so much because, you know, the Chinese treasury market, what do you call it, 国债, 国库券, yeah. So there's, I don't know how much arbitrage capital goes there to trade. And also, the reason why the treasury market was so central in the US was because there were a lot of supporting securities, the swap market, the LIBOR market, the, you know, the euro-dollar market, the bond market, exchange-traded market for treasury futures as well. You have a lot of these markets. So this arbitrage activity does not live in vacuum. It lives in a very nice supporting environment of financial markets. In China, not so much. So maybe for the future, so going back to the future of finance, so maybe for the future there is more room for this type of research to be relevant for finance in Shanghai, in China. But for now, I don't see this to be readily available. You know, if you're a PhD student, you might get this idea and go back and do some yield curve fitting. You tell me whether it's going to work in the Chinese market or not. So one last analogy I want to make is that when I was growing up, I lived in Puxi, and you know, there were not a lot of lights, not a lot of high rises. So last night I look out from my hotel room, I look at across the river to Puxi area. It's just full of buildings, full of lights. So this is a huge, huge improvement. Well, I shouldn't say improvement, a huge difference. Okay? I don't know how to feel about it yet. So the analogy here is that financial markets, you know, the stock market only started when I left China in 1990. So maybe there will be more lights in the Chinese market to some point when we can do this more precise quantitative research in finance, like what we do in this paper. Okay? So that's all that I want to talk about.
Okay. We have time for, I think, 2 questions. If you want to raise your hand if you have a question.
Hi, thank you very much. Very, very interesting talk. I wanted to ask you a question. I don't remember, in the 2 curves that you showed us, there appeared to be a concentration of noise, I think during the Lehman crisis for long-term maturity, and for the other 2 examples in the low maturity end of the curve. Mm-hmm. Is that, do you think, a reflection of the perception of uncertainty related to long versus short-term maturities, or is it more the allocation of arbitrage capital that is mostly geared to short-term arbitrage in, I don't know, 87, and shifted more to long-term maturity arbitrage in the 2005, 2006, yeah, 2008 period? Yeah, that's the first question. The second one, okay.
Okay, why don't I answer the first question first, sure. So I remember. So this is a very interesting question because we thought about this quite a bit. So cross maturity, how do we think about it? Okay, where, you know, you look at this, especially 2008, the 10-year area, the longer maturity really widened. Okay, so do we want to focus on one maturity? That's something we thought quite a bit about. So if you want to take our measure to the simpler case, it will be the 5-year on the run, off the run premium and the 10-year on the run, off the run premium. Okay? So you pick different points on the yield curve. What we have here is aggregate across the yield curve. We feel quite strongly about it because illiquidity happens across the yield curve, or arbitrage activity happens across the yield curve, maybe concentrated more over the longer maturity relative to the shorter maturity, but it should show up in the entire yield curve. So by averaging our noise measure across the yield curve, we pick up this commonality of deviation. So that makes our measure more superior to focusing just on the 10-year or just on the 5-year. And I have, you know, other numbers we report in the paper comparing our measure to the 10-year and the 5-year on the run, off the run premium, and you can take a closer look. And we also do our cross-sectional test, the hedge fund pricing test, the currency carry trade test, by running different yield curves, say 5-year, different parts of the yield curve, 5-year on the run, off the run, 10-year on the run, off the run. The only thing that really works is our illiquidity measure. So our illiquidity measure pick up different points of the yield curve, pick up the commonality across the yield curve, and that's gives it extra kick. Okay. Does that answer your question?
Yes, thank you. I leave space to other people who want to ask questions.
I actually think we need to stop there because we're short on time, so
Okay.
thank you very much.